Hey, good evening, everyone. How are you doing? So, a warm welcome to our LRF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. And before we begin, if you can hear me clearly, please confirm in the chat box by typing yes or 111 in the chat box, or share an emoticon if you're able to listen to me clearly. Great, thank you very much. Now, today's topic is spread trading with Malaysia futures. This LLF webinar series is proudly brought to you by Bursa Malaysia in collaboration with our company Excellent. I'm CY Saw, your moderator for today's session. We are privileged to have Chin Yixuan joining us to share about spread trading with futures in Malaysia. I see more people have just joined the webinar room. Welcome. Once again, before we begin, let's do one final sound check. Please type in 222 or yes, or give us a thumbs up in the chat box if you can hear me clearly. All right, great. Thank you very much. And if needed, please adjust your volume settings to ensure optimal sound quality. To ensure you have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will help you and ensure everyone can enjoy uninterrupted webinar and have an optimal learning experience. Today's session will be divided into two parts. The first part, Yifan will present his sharing. Following that, we will have a Q&A session where you can ask any questions related to today's webinar topic. To ensure we can address your questions effectively, please follow these steps. Submit your question in the Q&A section below and send them to all co-hosts, as this will help me capture your questions easily. And please note that due to high volume of messages maybe running in the chat box, it may be challenging for me to spot your questions if you don't use the Q&A box. So feel free to type your question in the Q&A box at any time during the session. As this LLF Let's Learn Futures webinar series is brought to you by Bursa Malaysia, we have a lineup of exciting topics ahead. Every Tuesday, we will host a new webinar topic in this series featuring sessions in English, Malay, and Mandarin. Our panel of speakers will share valuable insights and practical strategies related to futures trading. And we have many content-packed and informative topics lined up, with more being added regularly. So if you're interested in enhancing your knowledge and skills in futures trading, simply scan this QR code to register. And don't forget to add these sessions to your calendar so you don't miss any of them. In addition to the LLF webinar series, we also offer the LLF online workshop. Now, this online workshop is different from the webinar. This is specially designed for those who are new to futures trading. In these workshops, we cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you to kickstart your first futures contract. Each session is 3 hours long. So if you're new to futures trading and would like to learn more, you can quickly register yourself in these online workshops. They are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants. So be sure to grab your seats quickly. Before we begin, it's my pleasure to introduce our speaker for today, Chin Yixuan. With background in economics from University Malaya, currently Yixuan is the general manager of Alcopedia Sdn Berhad, which is a proprietary trading firm in Malaysia specializing in algorithmic trading. He has over 5 years of content creation experience on personal finance and investment via his personal blog, nomoneyla.com. Besides that, Yi Xuan is also featured in various media platforms such as City Plus, FM, BFM Caijing, and others. So without further ado, I'm delighted to hand over the presentation to Yi Xuan. So Yi Xuan, there you go.
Good evening, everyone. My name is Yixuan, and let's proceed to the sharing session today. So what we are going to talk about today is the topic is Introduction to Spread Trading with Malaysia Futures Products. Now, before we proceed, a quick disclaimer. This presentation is provided for general information only. It is not intended as an investment advice, offer, or solicitation for the purpose of sale of any securities, stocks, futures, or investment products. Stocks, securities, and futures imply risk and to be undertaken only if you understand the risk. Please seek your own tax, legal, and financial advice before investing in stocks and futures. All information in this presentation is subject to change without notice. Now, what are we going to talk about today? First of all, we are going to talk about spread trading. I'm going to introduce spread trading to everyone and why a trader should consider trading spread. And secondly, we are going into more practical application of spread trading. I'm going to share with everyone how to formulate a spread trading strategy or idea. And number three, I'm going to share with everyone what is the downside or risk of spread trading. And lastly, and for those of you who are new, I'm going to share with you how to get started with spread trading. Now, before we proceed with spread trading as a whole, I want to ask everyone that's sitting in today, any one of you have traded futures before? If yes, type 1 in the comment section below. If you have not traded futures before, type 2 at the comment section and perhaps let me know what other instruments do you trade aside from futures. Right, so I see a balance of audience. Some of you have traded futures before, some of you have not traded futures before. So don't worry, for the sake of everyone, I will share the basic of futures as a trading instrument, because what I'm going to share here will relate to the important session that I'm going to share later. So what is futures essentially? Essentially, futures represents an agreement to buy or sell an asset at a future date at an agreed upon price. So when you trade futures, right, you get a lot of access to various products, such as energy products like crude oil or natural gas, metal products like gold, silver, and copper. You also get access to market like commodities products like soybean, corn, wheat, and our very own crude palm oil. And not only that, you also get access to stock indices like the S&P 500, the NASDAQ, the Dow Jones, and even our very own FKLI index. Now, what makes futures so special compared to the likes of maybe trading stocks or Forex, as in this case, right, is this thing called contract month. A unique feature of future trading is that the trader have the ability to trade futures contract with different expiration month. So, for example, right now, you can, for traders, you can trade the July crude palm oil contract. At the same time, you can also trade the August and September crude palm oil contract. So, just a quick segue. For crude palm oil, I'm going to use the short form of crude palm oil futures contract, which is FCPO. Okay, so I'm going to use this interchangeably. Okay, so coming back, so as a trader, you can, in the futures market, you can trade not only the July 2024 FCPO contract, you can also choose, if you want, to trade the August 2024 and September 2024 futures contract. So, and not when it comes to, because there are different contract month in futures, so we have a different term for it. So for contract month that's nearest to us, we call them the near month contract. Okay, for the contract months that are further from us, we call them the far month contract. Okay, so as an example, right, for us right now, since it's July, so July would be a near month contract for us, and months like August and September would be far month contract. All right. Now, because of this very special phenomenon in the futures market where you get to trade contract with different expiration month, you have a very special phenomenon that you can see in the futures market. The first price phenomenon is what we call contango. Contango is where the price of far month futures contract, as an example, September, right, are higher than near month futures contract like July. So as you can see on the first row of the visual that I'm sharing with you, okay, the price for August 2024, sorry, let's start with the price of July 2024 first, is 4,000 ringgit, followed by August 2024, 4,050 ringgit, and September 2024, 4,100 ringgit. So we can see the price is rising across the expiration month. So this is what we call contango. Now, the next phenomenon that we can see in the futures market is called backwardation. So backwardation is essentially the terbalik, right, of contango. It occurs when the far-month futures contract, in this case, September or August, are lower than the near-month futures contract, which is, in this case, July. So as you can see in the second row of the visual, okay, for July 2024, the price is 4,000 ringgit. But this time, for August and September 2024, the price is 3,950 and 3,900 respectively. So you can see the price is going in the downtrend. So this is what we call backwardation. Now, at this point, I want to test everyone, just a quick test or quiz so I know that you understand where I'm going. All right. So right now, in this slide, you see two pictures. First of all is July 2024 at 4,500 ringgit and August 2024 at 4,550 ringgit. So is the price for far-month? Okay, so my question is this a contango or backwardation, ladies and gentlemen? All right, I see a lot of answers coming in. Yes, it's correct. It is contango. This, for those of you who are just in, so essentially contango is where the price of far-month contract is higher than the near-month contract. This is what we call contango. Okay, so in this case, the price of August contract is higher than the July contract. Now let's move on to another quiz over here. So imagine in this case, July 2024 is 4,500 ringgit and August 2024 is 4,150 ringgit. So is this a contango or backwardation? All right, I see a lot of answers coming in as well. It is a backwardation. Okay, so backwardation is essentially where the price of August contract, in this case, the far-month contract, is lower than the July contract, which is the near-month contract. Okay, to show you in a visual manner, okay, what contango and backwardation is, right? Take a look at this chart over here. Is what we call this the forward curve, where it shows you the price difference between different contract months. Okay, so in this case, you take a look. I want to divert attention to the green arrow first. The green arrow is what we call contango. Okay, so if you have understood what I've said just now, contango essentially is where the price of far month is higher than the near month. So that's why you see the price is sloping up. Okay, the forward curve is sloping out. Okay, meanwhile, backwardation is represented by the pink color arrow. All right, so what it means essentially for backwardation is you can see the price of futures for far month contract is lower than near month contract. That's why you see that the arrow is pointing downward, is sloping down. Okay, now some of you at this point might have the question, okay, where do I get this forward curve? Okay, it's very simple. You can try it out yourself. I'll show you how to get it. So I think most of you are familiar with your chart, the charting platform called TradingView. Most of you who invest know what is TradingView, right? So essentially, if you want to find the forward curve of a futures product, simply go to futures chart on TradingView. In this case, I'm typing FCPO. FCPO represents crude palm oil futures. Okay. Now, once you type FCPO, then on your right, follow my on the top right corner of the screen or the slide over here. Click on the menu or watch list chart icon. Then you scroll down, you'll be able to see the forward curve of a particular futures product. So in this case, we are looking at the forward curve of a FCPO or crude palm oil futures. Okay, so then you can explore for yourself the difference in contango and backwardation nature of a futures product. Okay, so just a quick wrap up or summary of this particular section. So first of all, for those of you who are totally new to futures, futures represent an agreement to buy or sell an asset at a future date and then agreed upon price. A unique feature of futures trading is you can, at least compared to the likes of stocks, is that futures traders have the ability to trade futures contract with different expiration month, just like how I showed you just now. You can trade July, you can trade August, you can trade September. Okay, so the contract that is nearest to us is, we call them the near month contract. The contract that is further from us, we call them the far month contract. Contango, there are two price phenomenon in the futures market. Contango is where the price of far month is higher than the near month contract. The next phenomenon that you can see is a total opposite. We call them backwardation, is where the price of far month contract is lower than the near month contract. Now, the reason why I cover some of the basics of futures just now is because if you relate to spread trading, and we will go directly into this. Now, before that, a question to everyone. Have anyone traded spread before? If you have traded spread before, type 1. If you have not, type 2. Okay, so I see a mix of reaction over here. So generally, I would say majority of the people here have not traded spread before, and which is okay. I'm going to cover today, I'm going to cover the very basic of spread trading. Okay, now, so essentially, what is spread in the futures market? Spread essentially, don't overcomplicate things, right? Spread is just a price difference between two futures contract. Okay, so in technical, or from technical point of view, when the trader say he or she trades spread, the trader essentially he or she is doing is just buy 1 month future contract and sell another month of future contract at the same time. So in this case, if you can see look at the picture over here, when we say we are trading spread, we are essentially buying the July 2024 FCPO contract and selling the August 2024 FCPO contract. So let's do a quick example, right? So let's say here is the July 2024 contract is 4,000 ringgit and the August 2024 contract is 3,960 ringgit. So my question to everyone here, what is the spread? What is the spread for July and August? Yes, the spread is 40 points. Yes, all right. Simple, right? Okay, nothing too complicated here. Now, let's try another one. If the price of FCPO for July 2024 becomes 4,100 ringgit, what is the spread right now? The spread becomes 140 points. Well done. Okay, awesome. Now, final quiz. Okay, so if instead, in this case, July 2024 contract is 3,950 ringgit and the August 2024 contract is 4,050 ringgit, what is the spread for July and August in this case? Right? The answer is minus 100 points. So essentially what I'm trying to share with everyone here is, number one, spread is just a price difference between two futures contract, right? Very simple. I'm going to share with you how we traders form trade ideas with this. And number two, what I want to share with everyone is, when it comes to spread, it's very normal to see positive and negative spread. So don't be shocked when you look at your spread chart in the future while you are trading spread and you see positive and negative figure. It's very normal in the spread trading while you are doing spread trading. Okay, so I bet that people that trade stocks will be very surprised by the negative figure. But yeah, this is something very interesting. Okay, all right. Now I'm going to show you in this picture what would you see when it comes to your trading platform for outright and spread trading. So on the first row, you will see the crude palm oil contract, the individual crude palm oil contract. So things like August, things like crude palm oil contract for July, August, and September. And the second row, you'll see the crude palm oil contract for the spread trading contracts. Okay, so in this case, you'll be able to see the July-August spread, and the next one, you'll be able to see the August and September spread. Now, let me show you how, let me validate together with you how the spread is being calculated. So in this case, let's use the first example, July and August. So when we want to calculate spread, remember we always buy 1 month and sell another month. Essentially, we buy July and sell August in this case. So my question to everyone, what is the spread for July and August based on the price that you are seeing right now in the screen? The answer is 44. So with that, right, we have validated that through this trading platform screenshot, we have validated that it's just calendar spread, spread is essentially just the price difference between two contract of different expiration month. Now let's use another example. In this case, August and September. What is the spread for August and September? Anyone? The answer is, yes, the answer is 16. So as you can see, it's actually very simple. It's nothing too crazy or it's nothing too complicated. Okay, but I know that by showing some of you guys number, it might still not make a lot of sense, but let me show you visually how it works. Okay, so as you with the chart over here, what you are seeing essentially is the two price chart for crude palm oil futures that with different expiration month. So the blue one represent FCPO for July contract. The orange line or price chart represents FCPO for August contract. So as you can see, if you observe closely, they essentially move almost the same, right? When one contract goes up, the other goes up as well. But if you notice closely, there's always a gap between them, right? No matter how small, there's always a gap between them. And ladies and gentlemen, this is essentially what we call the difference between all the blue line and orange line is what we call spread. Okay, this is spread. All right. Okay, now that we have learned the basic of spread, let's go more in depth into spread trading. Okay, spread trading. What is spread trading? Essentially, right, when it comes to trading spread, what us spread traders we are looking is essentially two things. At its simplest form, spread trading refers to traders speculating on the price difference between two futures contracts of different months. Okay, so this is also known as calendar spread. So there are many forms of spread trading in the trading world. Okay, so what I'm going to share with you or what I'm going to discuss today is the most basic version of spread. We call it calendar spread. So basically 1 month minus another month, 1 month minus another month. Okay, there are many other more complex spread in the market. Is something like butterfly spread. There are also inter or intra commodity spread. So nevertheless, let me just cover the basic here today. All right. Now, when a spread trader is being bullish, okay, when a spread trader is being bullish on the spread, what we are looking for essentially is the widening of a calendar spread. Let me show you what I mean by this. So, as an example, let's say today the price of FCPO August 2024 is 4,000, and the price of September 2024 FCPO contract is 3,950 ringgit. The spread is 50 points. Now, once I take a look, if I'm bullish on this, and next week the FCPO price for August become 4,100 ringgit, and meanwhile the FCPO price for September 2024 becomes 3,960 ringgit. So the August and September spread becomes 140 points. Okay, now today 50 points, next week 140 points. So my question to everyone, has the spread widened or narrowed? Has the spread widened or narrowed? Okay, I see a lot of answers here. Thank you, everyone. So yes, the answer is correct. The spread in this example, the spread has widened, all right, from 50 points to 140 points. So this is essentially what we are trading, okay? Now, let's look at the other side of story. When spread trader says he or she is being bearish on the spread, we are basically looking for the spread to become more narrow with time. So in this case, let's say today, the spread is 50 points, okay? Next week, the spread, the August 2024 contract is 4,100 ringgit, and September 2024 contract is 4,080 ringgit. So right now, the spread becomes 20 points. Okay, ladies and gentlemen, what has the spread become in this at this point? Widened or narrowed? All right, narrow, right? So this is correct, everyone. Thanks for the response. Okay, keep coming with all the response which I'm going to share, going to ask all of you later. Okay, so essentially in this case, when we are being bearish with a spread, we are essentially looking for the spread to narrow with time. Okay, now for those of you who are very familiar with what we call directional trading or outright trading, basically buy low, sell high, right, and so on. So, as an investor, as a trader, I think most of you know what is outright trading. So what I want to show you is the difference between outright trading and spread trading. Essentially, the difference in definition between of bullish and bearish definition between outright trading and spread trading. Okay, now for outright trading, when you are bullish in outright trading, you're essentially betting or speculating that the price will increase with time, right? Makes sense? You buy low, sell high. Okay, when you are bearish, when it comes to outright trading, you're essentially speculating that the price will go down with time. Make sense? Okay, I think this would make sense for a lot of us because especially if you are very familiar with investing and trading. But on the other hand, for spread trading, when we say we are being bullish, right, we are not actually really looking at the direction of the individual contract, futures contract. Instead, we are looking for the spread to widen. So in this case, if you look at this chart, right, it doesn't matter if the price, whether the direction of price is not the most important thing. The most important thing is that with time, the price difference, right? Remember the keyword here, the price difference between both contract widen with time. Okay. Now, when we say bearish, right? When we say bearish, we do not, again, the direction of the price doesn't matter. It's more on the price, it's more on the price difference that matter. So in this case, when we are spread trader is being bearish, essentially we are looking for the spread to become more narrow with time. Okay, so if you take a look at this particular chart on the right, the price of both contract increase, but we are, as a spread trader, we still make money. Why? Because again, let me repeat, this is very important. It does not depend on the direction of the individual contract. What matter is the price difference, right, between each spread contract. Make sense? Okay, so I hope this particular visual comparison will help you, give you a better understanding between what is being bullish or bearish mean in outright trading and spread trading respectively. Okay. Now, to summarize what we have learned so far, okay, I want to divert everyone's attention on the green side of the table. When you are buying a calendar spread, what you are doing is you are essentially being a bullish trader in this case. And you make money when the spread widens. Okay, when the spread widens, you make money. When you lose money, on the other hand, is when the spread narrows, right? You are betting on the spread to become wider with time, but when the spread narrows, this is where you lose money. Okay, understand? Now, on the other hand, when you're selling a calendar spread, essentially you are betting, you are being bearish with the spread, and you make money when the spread narrows, and you lose money, easy, right? You lose money when the spread widens. Now, let me show you a quick P&L calculation, how to calculate a P&L for spread trading. Okay, so let's say today the price of FCPO August 2024 is 4,000 and FCPO September 2024 is 3,950. So the spread over here is 50 points. Okay, next week, FCPO August 2024 is 4,100 ringgit and FCPO September 2024 is 3,960 ringgit. Okay, in this case, the spread has become 140 points. Okay, so if we are bullish, ladies and gentlemen, if we are bullish with this spread, how many points have you made in terms of profit? How many points have you made? In terms of points, just in terms of points. So yes, correct. 140 points minus 50 points, you get 90 points. So your profit is 90 points. So let's say, okay, the value per point for FCPO contract is 25 ringgit. Okay, what is in terms of RM? All right, in terms of RM, how much have you made? How much have you made in terms of RM? So remember, we made 90 points from this trade, but in terms of RM, how much did you make? Anyone? Yes, correct. Thank you. So in order to calculate your profit and loss, in this case, profit, right? What you need to do essentially is you got to take the profit in points, in this case, 90 points times by the value per point of the underlying futures product. In this case, for FCPO, the value per point is 25 ringgit. So your profit, total profit in this trade is 2,250 ringgit. Okay. Now that we have covered spread, the basics of anatomy of spreads, right? We gotta cover why trade spread. Some of you might be wondering why if you walk into some of the professional traders, futures traders, you ask them what do you trade, some of them will tell you they trade spread, right? Let me answer the question of why some traders, at least why some top professional traders decide to trade spread. Okay, first of all, it's the lower margin requirement. Spread trading requires lower margin requirement. So why? Because calendar spread, they tend to have lower volatility than outright contract. So as such, generally, calendar spread has a lower margin requirement relative to an outright contract. So let me show you a screenshot here. This is the crude palm oil futures contract for September and October. So if you see the yellow highlighted area, this is the margin requirement to initiate a trade in either September or October, respectively. So initial margin, for those of you who are not familiar with future, means that the amount required, that the initial amount required by a trader to open a trade, just to open a trade, right? So in order to open a trade for September 2024, you need an initial margin of 7,000 ringgit in your account, okay? And maintenance margin essentially means that the amount that the trader must keep in his or her account if he want to keep holding the trade, maybe for a few days or a few weeks or months, okay? Now, on the other hand, right, so basically what I'm trying to share with everyone here is that if you want to trade a futures contract, individual futures futures contract like September or October, okay, you need quite a bit of capital just to trade one contract. But on the other hand, what if you trade the September October calendar spread? Okay, if you trade the September October calendar spread in this screenshot, is taken at the same time. Okay, all these three screenshots, you only need 1,300 ringgit of margin. So imagine it's much more capital friendly, especially for traders with a smaller capital size. Okay, so as such, this is one of the reasons why so many traders decided to trade spread, because it's very margin friendly. Okay, it's easy to get started, especially if you have a small account. Now, the second benefit is that there's very clear seasonal pattern especially in some of the underlying futures instrument for their spread. Okay, they tend to display a very consistent seasonal pattern. So as an example, I will show you this. I'm going to explain more later, okay? But for now, just focus on how consistent the spread seasonal pattern is. So example, FCPO spread tend to narrow in May. So as you can see over here in the screenshot, represents the June and July calendar spread from 2022 to 2024 for 3 years. So for all 3 years, if you take a look, right, in the month of May, the spread tends to be bearish. In other words, the spread tends to become narrow. So this shows you that there's actually, for those of you who are familiar with trading, you already have a hint of how you can trade spread, right? Okay, but don't worry, I'll show you more details later. Okay, so this is another benefit of trading spread, clear seasonal pattern. So a quick takeaway from what we have learned so far, why trade spread? Number one, calendar spread has a lower margin requirement than trading outright futures contract. That's why it's more capital friendly for traders with a smaller capital. Okay. Now, for another benefit of trading spread is for some instruments, their calendar spread tend to display a very consistent seasonal pattern. Of course, it's not always 100%, but it's very reliable. Okay. Now, we have come to the, I would say, the most important section of this whole presentation. Okay, how to form spread trading ideas with Bursa Malaysia derivative futures product. Now, just a quick introduction. Do you know that in Malaysia, our very own Bursa Malaysia derivative product, there are a lot of very vibrant products. Okay, let me just show you some of them. Okay, first of all, I've talked about this a lot today, is the crude palm oil futures product. And we also have the soybean oil futures. Not only that, we also have equities futures like the FKLI futures, F4GM futures, and FM70 futures. We also have precious metal like gold futures. And not only that, we have also this year we are also able to trade the USD and China renminbi FCNH futures. So imagine from commodities to equity indices to precious metal to even currencies. There are so many products that you can choose to trade when it comes to futures market in Malaysia. Okay, pretty interesting, right? Now, with that in mind, how can you form trade ideas with spread trading? For those of you who pay attention in the previous section, you know, okay, for the first thing that we can use, first technique that we can use to form trade ideas is what I call seasonal and fundamental analysis. So seasonality represents a repetitive and relatively predictable pattern in the market, while fundamentals involve factors like inventory level, weather, production, and consumption. Now, when we combine the knowledge of seasonal pattern and fundamental, it can be very helpful in helping you build a trading edge as a trader. Okay, so especially if you are watching, if you are a trader, then you are a little you are not sure what to do in your trading journey right now. This is the section that you need to pay clear attention to, because I believe after tonight you might not have the full picture yet, but you have a clear direction of where to work on. Okay, especially if you are a trader that's looking for a specific direction in your trading journey right now. Okay, now let me go into more detail. Let's start. I'm going to give you an example of FCPO. All right, let's do a seasonal and fundamental analysis of FCPO. Okay, FCPO is one of the most traded futures contract in Malaysia. And in fact, do you know that Malaysia is the second largest CPO producer in the world? Right, of course, the first being Indonesia right now, but Malaysia is the second. Okay, now in Malaysia, palm oil is produced in states like Sabah, Sarawak, Johor, Pahang, Perak, and Seremban. So if you take a look at this map over here, basically you can see that the majority, okay, of palm oil is produced in states like Pahang, Johor, Sabah, and Sarawak. If you look at the red dots, okay, this is where you see a lot of palm oil mill where they process all the palm oil. Okay, and this is important. This map is important because it will relate to what we are going to discuss later. So just remember Sabah, Sarawak, Johor, Pahang. Okay, Sabah, Sarawak, Johor, Pahang. Okay, and palm oil production is highly seasonal in Malaysia because in Malaysia there are certain months, right, that is very rainy. We call it rainy season. Okay, and there are certain months that is very dry. Okay, so what does that mean? Okay, so in November and March, okay, now we have come to seasonal analysis, right? Ladies and gentlemen, pay attention, okay? In November and March, in Malaysia, we typically experience this thing called the northeast monsoon, or in Malay, we call it monsoon timur laut, where they tend to be heavy rainfall in palm oil producing states like Johor, Sabah, Sarawak, and Pahang. Okay, so this is where what this means, right? What the impact of this essentially is November and March is, since it's seasonally more rainy, right? Production usually of palm oil usually drop, and they usually bottom around February and March. Okay, after that, when the rainy season has subsides, right? What will happen is after from April onwards, April or May onwards, right, where there's seasonally less rain, production of palm oil will pick up in April or May, and they will usually peak around October, all right? What this means, right, essentially is what is number one. Before that, let me just cover one quick thing first. Okay, we have talked about how spread they tend to widen or narrow over time, but I haven't shared with you some of the reasons why they widen or narrow, why they move that way they do. Okay, one of the reasons why spread they tend to widen or narrow is due to uncertainty. Okay, remember the word uncertainty. Of course, this is just one of the many reasons, but uncertainty is one of the key reasons why, especially when it comes to commodity or trading, they tend to affect or influence the spread. Okay. Now, generally, uncertainty at the present moment will cause near-month contract price to rise more than far-month contract. Okay. So, as an example, let's say initially the price of palm oil, near-month palm oil contract is 4,100 ringgit, and the price of far-month palm oil is 4,050 ringgit. And the spread over here is 50 points. What if, right, we suddenly experience a rainy season where the rain falls heavily, right? It will cause the palm oil production to drop. And what will happen? Okay, keyword here, there will be higher uncertainty at the present because there are more risks at the present. You do not know what will happen, right, with all the production and everything. So this is where the spread tends to, this is where the price of palm oil at the near-month palm oil contract tend to rise in an extent that's larger than the far-month palm oil contract. Okay, as such, you can see the spread becomes, in this case, the spread becomes 250 points for illustration purpose, right? This shows that the spread has widened. Now, on the other hand, once the uncertainty at the present moment is resolved, okay, near-month price will stabilize against the far-month contract. So as an example, so let's say the dry season, the sunny season has come, right? The rain has subsided. So what will happen from, let's say just now, the price of near-month palm oil contract is 4,500 ringgit, and the price of far-month palm oil contract is 4,250 ringgit, which means a spread of 250 points. So if the rain subsided and everything becomes normal, back to normal, what will happen is, what you'll see generally is the price of near-month contract will drop more than the price of far-month futures contract. So in this case, if let's say it dropped for near-month contract, it dropped from 4,500 ringgit to 4,300 ringgit. And for far-month contract, dropped from 4,250 ringgit to 4,150 ringgit. So both drop, but the near-month drops in the larger extent compared to the far-month contract. So in this case, the spread actually becomes more narrow with time. Okay, so basically what I'm trying to show you here is that uncertainty will cause the spread to widen while on the other hand, once uncertainty at the present moment is resolved, then the spread tend to becomes more narrow. I'll share with you in practical historical seasonal pattern, how it works, right? So in this slide, so essentially what we have learned so far is that for crude palm oil, the rainy season tend to be until March, February or March. So and starting April, there will be seasonally less rain, and hence production tend to pick up in around the month of April or May. So what's the seasonal tendency here? So when in the month of April or May for crude palm oil, the production tend to recover. Okay, and then when the production recover, right, there's less price premium for near month FCPO contract due to there's less uncertainty already because the weather has become better and production is recovering. Okay, when there's less uncertainty, what will happen is the FCPO spread tend to narrow in May. Okay, in other words, what I'm trying to say here is FCPO spread tend to be seasonally bearish in May. So let me just show you the chart that we have seen in the previous section. So if you see over here from 2022, 2023, 2024, in the month of May, okay, the spread for June and July calendar spread has consistently been bearish. So this is a very, I would say, a reliable way, unless there are a fluctuation in the fundamentals of the weather and so on. This is a very reliable way to trade spread as a spread trader. Okay, and there's no guesswork in this case, right? If the fundamentals are correct, if the weather and everything is within what we are expecting, then this is something that we can trade on, right, as a spread trader. Okay, now I'm going to show you another example here, which is FKLI, the Kuala Lumpur Composite Index Futures. Okay, so FKLI tracks the FKLCI index, which comprises of the top 30 largest listed companies in Malaysia by market cap. So unlike commodities futures products like the FCPO, which relies a lot on things like inventory, and relies on things like weather or production, FKLI as an equity index, right? Their seasonality is partly influenced by the things like dividends. Okay, so as such, what's the seasonal tendency here? Is that you see the price of FKLI contract in February be higher than FKLI futures contract in March. Why? Because March is the time of the year where dividends is announced. That's why you see that for the price of March FKLI contract, dividends are usually factored in their pricing. So essentially what I'm trying to say here is that February tend to be seasonally more bullish, right, for the February and March FKLI calendar spread. Okay, let me show you what it means, what I mean, right? Let me show you a chart over here. Okay, so this chart over here, in the price line, the price chart in blue is the FKLI February 2024 contract. The orange line represents the FKLI March 2024 contract. So you can see, right, the price of the orange line, which is represent the March FKLI contract, is consistently lower than the blue line, which is the FKLI February contract. Okay, so if you look at the green highlighted square, a zone, right, so to say, is the month of February 2024, you can see that the spread is widening over time. So if some of you might at this point might not spot it yet, because I agree, it's not actually not very obvious. But if I show you the spread chart, this is essentially the same thing. It's just a spread, the price difference between February and March. You can see that for the month of February, right, is actually bullish. So the spread is actually widening over time. Okay, so this is also another consistent seasonal pattern that you can see in the FKLI futures. Okay. Now, another way that you can trade spread is through, I think a lot of traders would be very familiar with this, is through pure technical analysis, things like price action, support resistance, right, indicators, and so on. So let me just show you a quick example. As an example, okay, this chart, we are seeing a very clean sideways pattern. So for those of you who are very familiar with support and resistance, right, where if you see such a clean price action, I think it's only rational to trade. It's only rational to trade the resistance and support respectively. Okay, so the third way you can do is combine seasonal fundamental study with technical analysis. So let's do a quick recap. So seasonal fundamental analysis will give you context and directional bias. Technical, on the other hand, will give you a better entry location. So remember just now, recall that FCPO, for the month of May, they tend to be seasonally bearish. So this is from our seasonal and fundamental study. So our bias for the month of May is always to look to go short, if everything, of course, if the fundamentals are correct. Okay, so now that we have gotten the fundamentals right and seasonal study right, now let's look for a good entry. So from this chart, we can see that there's a very clear sideways pattern, and the clean resistance and turn support is formed at 37, the price of 37. Okay, so on the other hand, another piece of technical context that we can get here is prior to May, right, there's already a clear downtrend being formed. Okay, and then, so when is the best entry in that you can spot, right? For me, if I were to enter a short in May, then I think the yellow arrow within the month of May would be my best entry, where the price breached below 37. We tested 37, and at the same time, we tested my downtrend, my trend indicator of 21 EMA. So this is, for me, a good entry point. Of course, you use your own technical indicators that you are familiar with. Okay, what I'm trying to say here is you can use you can combine seasonal pattern and fundamental studies alongside technical analysis to make a trade decision, make a better trade decision, so to say. Now, I want to cover quickly the downside of spread trading. The downside of spread trading is because remember, when you're trading spread, you're essentially taking, in this case, right, in this example, you're taking a long buy, you are buying a August 2024 contract and you're selling a September 2024 contract. Okay, so when you're taking a calendar spread trade, you're essentially taking two individual contract trades. Okay, so in other words, you're actually paying 2 times the commission. So what do I mean by this? So essentially, if I'll use a keyword here, is called round turn, which means you are entering and exiting a trade. So let's say the commission is, I'm comparing a 6 ringgit round turn commission and a 5 ringgit round turn commission. So initially, the spread of the commission for one spread contract is 12 and 10 ringgit respectively. The difference is just 2 ringgit. But if you are a very active spread trader, if you are trading until 100 spread contracts per month, the difference that you can save, right, with 1 ringgit of saving in round turn commission would be 200 ringgit. So that's why for spread trader, it's very important that you get the best deal from your broker. Okay. Now, the second downside I would say for spread trading, at least right now in the trading community, is there's a lack of information online compared to outright trading that you can easily find on the places like YouTube and Google. Okay. But however, right, if you visit Bursa Academy's website, I noticed that there have been a lot of accumulation of very interesting and insightful futures trading and spread trading related content over the years. So please feel free, if you want to learn more about spread trading, feel free to go to Bursa Academy website. Okay. Now, the other downside I would say for spread trading is they are generally lower liquidity. Okay. So I want to show you what I mean by this. So on the first row, you are seeing the individual contract volume for July, August, and September. On the other hand, at the bottom row, you are seeing the volume for calendar spread for July, August, and August, September. As such, right, you can see visually from the difference in volume, right? Generally, the volume is lower when it comes to trading spread, at least compared to outright trading. Okay. So some of you might be wondering how to get started with spread trading. Okay. First of all, I think personally, I would say the best, I would say all-in-one place to learn about, especially futures and spread trading, is Bursa, right? In Bursa, you can learn things like fundamental, seasonal, and technical analysis. There are so many webinars that's being recorded over the years. You can just find a lot of nuggets, golden nuggets about trading in Bursa website. All right. And next, after learning all these things, I would suggest you to look for brokers that offer spread trading. So if you are interested about which futures broker are there, you can again go to Bursa website and in this case, Bursa Marketplace, and click on open a trading account. Then you'll be directed to a list of futures broker that's available in Malaysia right now. All right. Now, while we are doing so, I would recommend that you, because unlike stockbrokers in Malaysia, right, futures broker in Malaysia, they don't publish, most of them at least don't publish their commission rate. So what you need to do is you gotta email them, ask them, hey, what's your commission, right? What give me the best deal. So you gotta reach out to them, ask them for their commission. So commission rate. That's why I implore all of you, if you are interested in trading futures, you want to open an account, go shop around, right? Ask for the best rate for yourself. Okay. Now, of course, you want to choose a broker that give you access to assets that you want to trade, like palm oil, FGLI, and even new products like the FSOI and also the FCNH product. So you can ask them if they allow you to trade all these assets or not. Okay, so I would say, I would even add on to say that you want to choose a broker that offers you a very good support, because futures product you can trade at night as well, right? It's not just the morning. So you can trade at night as well. So you want to support that you can reach out to 24/7. At least at night, you can also reach out to them, right? You also want to have a broker that offer you platform that you can do your charting and shows you the price ladder as well. Okay. Now, some of you might have questions after our discussion today, how to find a spread chart. Okay, let me show you quickly how to find a spread chart. Now, before that, you're gonna understand one thing. In futures, for the month of January until December, they use an alphabet to represent different months, right? It's just what it is, okay? So example, for the month of January, you have the contract month, the contract alphabet is F. February is G, and so on, okay? You can see on the list, on the table on the left over here. So how to find a spread chart in this case? So I'm going to use the most, I would say, commonly used charting platform, TradingView. If you are interested, you can try it out for yourself. Go to TradingView, right? Key in the ticker and contract month and year, minus the ticker, contract month, and year for the subsequent contract, and hit enter. So in this case, what I'm showing you here is the FCPO for. If you see FCPO Q 2024 minus FCPO U 2024. So Q essentially is the month of, what's the month for Q? Anyone? What's the month for Q? Yes, the month of Q is August. The month of U is September. So I'm looking for the spread chart between FCPO August 2024 and FCPO September 2024. You can try it out for yourself in TradingView. And once you hit enter, you'll be able to see the chart. Okay. Now, personally, I would say if you look at this chart, it can get very dizzy because you look at all the candles, right? So personally, what would I do normally is I will go to the candle selection. I'll choose area instead of candles. So when I choose area, you'll get a clearer view of the overall trend of the calendar spread. All right, makes sense? So go try it out yourself after the webinar. All right, it'll be pretty interesting. Now, then another way you can get a spread chart is through your trading platform. In Malaysia, most futures broker offer this platform called Quick Screen Trading, or QST. So essentially, just type, they use a different symbol in the QST platform for FCPO. It's called MPC. So same thing, MPC, August 2024, Q24, and U24. And when you hit OK, you get the calendar spread chart. Okay. So, but for those of you who do not have a broker yet, don't worry, go try the TradingView method that I showed all of you just now. Okay. Okay. Last question. Last thing that I want to address: how much do you need in capital to get started with spread trading? Okay. To answer this question, let me show you. First of all, step one: identify the margin requirement for the calendar spread that you want to trade. So margin, again, as a reminder, essentially is the amount you need in your account to initiate and hold your trade. So in this case, the margin is required to trade this MPC or crude palm oil August and September contract is 1,500 ringgit. So you will need to start with, you need to have at least 1,500 ringgit of capital in your trading account. Then, because for most of us, at least, when we execute a trade, it will not immediately go in our favor. Sometimes you go against us, sometimes you stop us out. So you need additional buffer in case the price goes against you. So you need more than 1,500. Okay, so let's say your stop loss is 300 ringgit. Okay, so then the bare minimum you should have as a buffer is slightly more than 300 ringgit. Make sense? Because you get account of things like commission and so on. So as an example, in this particular scenario, the capital that you need to initiate a one contract FCPO Q24, in this case August, right, and U24, in this case September trade is, I would suggest personally, 1,500 ringgit of margin, and you gotta have an additional buffer of more than 300, in this case 500 ringgit. So you gotta have at least around 2,000 ringgit to initiate a calendar spread contract. Okay, so this is, I wouldn't give you like a ballpark number of how much you need in terms of absolute number. I'm going to show you how to, at least a direction or step by step, how to decide the capital size that you need. All right, hopefully this is helpful for those of you who have a question on how much you need to start trading calendar spread. Now, take away from this session is number one, understanding the fundamental of spread and for the instrument that you like to trade. Okay, if you want to get started, right? Learn technical analysis for a more precise trade execution. And obvious or for brokers with a more competitive commission. Email them, ask them, okay? And also all for brokers that allow you to trade spread. When you ask them about commission in the email, ask them also whether you're allowed to trade spread. All right. Ask them also that whether you can trade a certain asset like FCPO or FKLI. Okay. And number four, look for a futures broker that offer you as a client a complete trading platform for charting and price ladder. Okay. So we have come to almost the end of the session for my own presentation. So let me quickly conclude what we have learned today. Number one, a unique feature of futures trading compared to other products like stocks is you can trade as a futures trader, you can trade contract with different expiration month. Okay. Secondly, at its simplest form, spread trading refers to traders speculating on the price difference, right, between two futures contract of different month. Okay. Why trade spread? Why trade spread, right? Because as a whole, generally, spread requires lower margin compared to individual outright futures product. And generally, right, for certain product, they tend to spread, their product tend to have, their underlying spread tend to have display very consistent seasonal pattern, which I've shown you just now in our discussion, right? And how to form trade ideas. Number one, seasonal and fundamental analysis. Number two, technical analysis. And even better, combine all of them so that seasonal and fundamental analysis give you a clear bias or direction on where to trade. And you use technical analysis for a more precise entry. All right. And of course, I want to cover the downside of spread trading is number one, higher commission. Be prepared to pay higher commission when you are trading spread, because at one time, whenever you initiate one calendar spread, you are essentially trading two outright contracts. So it's always commission times two, right? It's always commission times two. And then, unfortunately, there's relatively lack of information about spread trading online. But luckily for us in Malaysia, Bursa has done a great job at accumulating all the knowledge and insights about spread trading over the years. Go to Bursa Academy, Bursa Marketplace, right? There are a lot of different materials there that you can look into, especially if you are very interested with spread trading. Okay. And finally, there's less liquidity when it comes to spread trading, which is something that you just gotta accept as a spread trader. Okay, so let me see. Okay, so this is pretty much everything that I want to cover today. Thank you so much, everyone, for being present, and I hope this has been helpful. And I should pass the stage to CY for the Q&A session.
All right, thank you very much, Yixuan, for your informative sharing. I'm sure our audience has gained a lot of valuable insights into the basics of spread trading. And it's now time for our Q&A session. So if you have any questions related to Yixuan's sharing, please type them in the Q&A box so that I can easily capture and address them. While we wait for questions to come in, I would like to ask a small favor from you. Please take a minute to fill out our feedback form since we have provided an informative session today. It will only take you less than a minute to complete. You can find the feedback form link in the chat box, or you can use your smartphone to scan this QR code. Taking a quick minute to share your feedback will greatly help us improve our future sessions and ensure we continue to deliver valuable content that enhances your learning experience. So please take 1 minute to complete the form and we will begin the Q&A sessions shortly. All right, another 20 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, thank you very much. For those who haven't finished yet, you can continue to do so. Now let's move on to the Q&A session. To ensure we cover as much ground as possible, I will select the most relevant questions from the Q&A box. And if your question is long, then I will break your questions down a little bit smaller so that I can rephrase them for easy understanding and clarity. And please understand that due to time constraints, we may not be able to address all questions. So Yishuan, are you ready for the Q&A?
Yes, yes.
All right, let's go with some of a few simple questions first. What are the benefits of trading future spreads?
Well, I think the most important, especially for retail trader point of view, the most important I would say benefit of trading spread is most certainly the lower margin requirement. So as I shown just now in the screenshot, for in the particular screenshot, right? For to trade FCPO September or October contract as an outright contract, you need 7,000 ringgit, which is quite a lot for a retail trader just to trade one particular contract. But if you trade the September and October calendar spread, right, your margin requirement is only 1,300 ringgit. So in other words, right, if you want to, if you are just starting to trade as a new trader with a smaller capital, or even an experienced trader with a smaller capital size, you want to grow it, you want to try to see if you are able to grow into a bigger account. Spread trading is always a much more preferred, in terms of margin, especially, it's much more preferred instrument or way to trade compared to outright contract, because just by the fact that you need much less capital to get started. And of course, the another benefit is, which I think there will be some questions coming in, is the very clear seasonal pattern for some of the spread pair, which we have discussed, right? So as I've shown you just our FCPO in the month of May, since 2022, 23, and 24, they tend to be bearish for all 3 years, which this shows a consistency. If should all the lines, all the stars lines up, then the seasonal tendency are very reliable. So I think these are, right off the bat, these are the two very reliable reason why a trader should consider spread trading.
All right. Another question. What are the risks or things that traders need to pay attention when trading spreads?
Yeah, good question. Especially for traders that use seasonal pattern as a way to trade spread. I think it's very important to notice when there's a shift in the fundamentals of the particular product. So I would say for as an example, yeah, let's use SCPO as an example. If um, there's a very hot season in the prior year, right? If there's a very hot season in prior year, it will affect the production because it will affect the production in the later year because when they start to plant and the palm oil and the weather is very dry and so on and there's not enough water, so it will affect the production down the line in the coming year. Same goes to very heavy rain. It will, usually we are expecting normal rainfall. Rainfall is expected in the month of year end, right? But what will happen if, remember 2022, very heavy rainfall, right? It will even trigger the spread price movement even further. So what I'm trying to say here is if you are a spread trader, especially if you are trading with the underlying seasonal pattern, you need to study the fundamentals. You need to pay attention to if you are trading FKLI, you need to pay attention to dividends, right? If you are trading FCPO, you need to pay attention to the weather, the production, and the demand. Okay, and or not even that, you need to pay attention to government policies, right? Like sanction and so on. And if you are trading things like gold, you gotta pay attention to things like interest rate. So that's you for me. My suggestion for so this is one risk that traders will need to know. But what my suggestion would be to, if you are starting out, right, try to understand the one single product. Don't try to trade so many different products that you are not familiar with. Try to be very familiar with the fundamentals of one particular product first. Then, and only then, you know what to do, right? You know how to make the better decision, not when things go out of the norm.
All right. There is one question I believe is something related to the basics of trading. There are many combinations of spread contracts, and how do I choose the right combination of futures contract to trade a spread?
Yeah, I think that is a good question. I think the most I think okay, short answer would be you want to choose the spread that is most related to the seasonal pattern that you are trading. So as an example, using the example that I've shown today, FCPO tend to be bearish in the month of May for the calendar spread of June and July. So the point I'm trying to say is, since production started to pick up around April and May, you want to choose something that's nearer to the month of April and May. In this case, June and July is a good pair that to choose from. But what I would suggest is you can go to TradingView, pull up the calendar spread chart, look at June, July, August, September, and so on for all the expired FCPO contracts, right? PS, in TradingView, you can view expired contracts like 2022, 2023, and so on. So go look for yourself, look at how the price or price movement for the particular month. Okay, then you can decide, okay, what calendar spread that you want to trade. All right, but my general, I would say, guidance, right? Of course, this is not an absolute answer. My general guidance is choose the one that is closest to the seasonal month that you would like to trade. Yeah.
All right, well, we are on the topic of selecting which contract months to trade, right? Do we need to look at the liquidity or the volume for that specific spread contract to trade?
From my personal experience, definitely this is one of the consideration. Okay, so if I were to look at a particular calendar spread, I see that on the bid and ask, the limit orders at bid and ask is just one or two contracts. Some even don't have any contracts lying up. I would, if given a chance, I would not trade the particular product because price can zip out and down very easily because there's a lack of liquidity in the particular market. But fortunately, for most calendar spread that I'm seeing right now, is generally it wouldn't be an issue for retail traders like with that trade smaller size to get their orders filled, right? Of course, unless you see like 1, 2, or 0 or no contract lying out at the limit and the bid and ask, then this is where you probably gotta think, okay, you gotta find a better pair to trade, in my opinion. Yeah.
Okay, so I believe what Yishan means is that, a general rule of thumb to find the best contract to trade is find the contract that has the most trading volume to trade, right?
Yeah, certainly, of course.
Okay.
But I would say aside from that is to avoid contract with very little trading volume. Yeah,
Okay.
from another perspective. Yeah.
All right, sure. Another question that is related to charting. Any idea that we can see expired spread chart?
Yeah, in TradingView, just now I've demonstrated on TradingView, you can type FCPO Q 2024 minus FCPO U 2024. So aside from 2024 contract, you can also view expired contracts like 2022, 2021, or even years prior. So no problem. You can take you can through TradingView charting platform like TradingView, you can see the previous expired calendar spread.
All right. Next question. When it comes to holding a spread position, how long do we need to hold for that? If we were to trade spread.
This is a good question. I think ultimately it depends on your trading style. First of all, your trading style. Are you comfortable day trading the spread? If yes, then in and out within a day or within a trading session, then that would be all right. But of course, again, remember that as you are trading spread, commission is always times 2 because you are always at one time you are trading 2 outright contracts for 1 calendar spread. So you are taking into account of the cost as well as a spread trader. So if you want to go in and out within a day and you produce a lot of trading volume, then you gotta be very conscious of the commission as well. But then again, if you are trading seasonal pattern, like I personally do, then I think generally you would like to hold at least a few days or weeks or even months for the seasonal pattern to form itself. Okay, because as a seasonal pattern, they don't just you enter then it happened, right? It doesn't work like that, right? You gotta give it time for the seasonal pattern to form itself. So again, it really depends on your trading style. Personally, I enter in and out within a few days or a few weeks, sometimes a little bit more than a month. Yeah.
Okay. There are several questions that is related to technical analysis. I see there is one long question. Let me break it down for so smaller questions so that you are able to answer.
Yep.
Firstly, are you able to let us know what is the relationship between production and whether production increase or decrease, will it cause spread to be bullish or bearish?
Good question. I think ultimately it comes back to a little bit of logic. So basically, when let's go back to the example that we have discussed today. So FCPO in the month of May, April and May. Okay, this is after the rainy season ended in February and March, right? April and May is where production will pick up. So when production pick up, right, it always come back to uncertainty, right? When there's less uncertainty, then generally, right? Of course, given the context that we have just ended the rainy season, and there's less rain right now, there's less uncertainty right now. So when production becomes normal, right, production picks up. In this context, uncertainty will, at least the current uncertainty will drop, right? Things will be more predictable because the weather has stabilized itself. So as such, in this case, in the particular example that we have used, right, for the month of May, generally the spread is bearish. Okay, so a general direction or rule of thumb I would suggest is always think when you are thinking whether a spread is bullish or bearish, think on the perspective of uncertainty. Is right now, is the near month more uncertain compared to far month? or is near month right now there are more certainty at the near month compared to the far month. So think in the perspective of uncertainty, especially if you trade products like commodity and energies. Of course, index is a different world, but for things like commodity product, energy product, this is a direction that you can get started with. Yeah, at least that's how I personally approach it. Yeah.
All right. Another question also related to a little bit with fundamental analysis. Will increase in demand cause a spread to be bullish?
Mm, yeah, technically yes, but it ultimately comes back to what causes the demand to increase. So, example, could it be a weather, could it be a disaster, and so on. So generally, we all know if there's a spike, a sudden spike in demand in certain product or something, right? We all know, like, remember the incident in 2020 when, especially at the start, toilet paper or tissue paper becomes the demand for tissue paper becomes a lot. So you can imagine this is a time where, right? This is a time where spread will become more bullish, right? Compared to normal times. Okay, so I would say it all again comes back to uncertainty, right? If uncertainty causes a spike in demand, and this is where you can use the method that I shared with you just now to decide whether a spread should be bullish or bearish. Yeah.
All right. Another question related to trading strategy. What technical analysis strategy is actually good for trading spread?
Mm, it depends. It depends on the context. Like, if remember the chart that I show, example of chart I show you just now, there's a very clean sideway. Now, typically for calendar spread, they are on the far further month. Like right now is July, August, September, right? If you look for further month contracts, they tend to be for contract that with a lower liquidity, they are less active, right? They tend to be many tend to show a very clean sideway pattern. So if you found something like that, then you can trade the sideway pattern. Of course, the caveat here is that you are trading contract with less liquidity, and as such, you gotta bear the risk yourself. But trading sideway is a very reliable way to trade spread. All right, and trend following, things like you are putting in a moving average, trade according to the moving average is also another way you can trade spread, especially when the seasonal pattern is happening, right? When seasonal pattern is happening, certain calendar spread tend to show a very clean trend to the upside or downside. This is where you can do some of the trend following indicators or analysis that we usually are familiar with. Yeah.
All right. Let's take a few more questions because of time. How do I analyze or identify a potential spread trading opportunities?
Mm, yeah, good question. I personally would say, especially for commodity and energy product, start with weather. Start with seasonal weather. So, example, in Malaysia, rainy season, we have rainy season and dry season. So, where's the opportunity? Okay, the opportunity is generally between the end of the season and start of another season. So this is where you see that because after one season and the rainy season ends, then the dry season will come, right? Or the less rainy season will come. So this is where you start to see switch in opportunity, right? Remember, so again, sorry, I gotta use back the example. Remember, end of rainy season in February and March, and then weather starts to stabilize. There's less rain, likely entering. Remember, Chinese New Year tend to be a very dry season. We are entering into very hot and dry season, and hence this is where a lot of seasonal shift will happen, right? A lot of new seasonal pattern will emerge. So this is where you can look into the month of April or May, right? To trade the season, to identify potential seasonal pattern. And for indices like FKLI, or you can look into dividend month, like the month of March, the month of September. Yeah, so this is where you can find seasonal opportunities.
All right. Let's take one more last question. What are some common mistakes that new spread traders make, and how to actually avoid them?
Good question. What are some of the mistakes that new spread traders make? Let me let me let me think about it. Okay, I would say the number one is to be very excited and you try to cover many products as one. Like as I mentioned, FCPO, FKLI, FGLD, and everything. Because Bursa is already a very vibrant, offer a vibrant suite of futures product. You try to trade every spread, and in the end, because you do not understand what's happening, what the underlying fundamentals and seasonal pattern of all these products, you tend to make a lot of mistake. Okay, so I would say in short, you don't understand the product, number one, and secondly, you don't understand a product, you oversize yourself. So when you put your sizing too large, right, and you trade too many contracts at once, when the things go against you, then it will disrupt your learning experience. So if you are starting to learn how to trade spread, my suggestion is to start with a small size. Focus on one product, start with small size, familiarize yourself with the particular product. Then you'll be able to, once you are familiar with one particular, I would say, product suite, right? Like FCPO, then you can move on to FKLI or you can move on to FGLD, right? So this will, so you can focus on learning instead of trying to make money at the start in the beginning.
All right. So basically speaking, that when it comes to if a person is very new in spread, it's best for them to stay focused in the products that they understand, right?
Yep.
Okay. Thank you very much, Ethan, for answering our participants' question. Now it's time to conclude today's webinar session. Now, once again, let me remind you about our upcoming webinars, especially for those who may have missed the earlier announcement. The LLF Let's Learn Futures webinar series features a variety of topics scheduled every Tuesday evening from 8:30 to 10 p.m. And we cover a wide range of content-packed and informative topics where you can gain practical knowledge about futures trading from our experienced speakers. So if you're interested in joining any of these sessions, simply scan the QR code to register for the topics you would like to attend. Once you scan the QR code, you will be directed to a page where you can access to our event calendar. To join our upcoming sessions, simply navigate to the Tuesday column of the LLF webinar topic section. Click on the session that you are interested in and proceed with your registration accordingly. In addition to our webinars, we also offer the LLF online workshop. Now, this online workshop is tailored for those of you who are new to futures market. And if you are interested in learning about futures trading in detail, then this online workshop is ideal for you. So you can take a picture or screenshot this page and register yourself right after this webinar ends. And feel free to share this event with your friends and families who are also interested in futures trading. Because in this workshop, we will guide you step by step on how to start trading your first futures contract. And do note that each session is limited to the first 50 online attendees. So be sure to register yourself quickly to secure your seats in both workshops. Again, same thing, once you scan the QR code, you will be directed to a page where you can see the event calendar. Go to the Saturday column and click on the workshop session that you're interested in and proceed with your registration from there. Bursa Malaysia hosts a website called Bursa Marketplace where you can explore a derivatives trading simulator, which is called the DTS. This simulator allows you to engage in paper trading, helping you to familiarize yourself with using a futures trading platform. You can register for a risk-free trading experience and give it a try to start develop your interest in futures trading. It's a great way to learn and gain hands-on experience through this trading simulator. Finally, before we conclude this webinar session, allow me to introduce you to Bursa Academy. Now, Bursa Academy is a comprehensive one-stop e-learning platform where you can access all the information and knowledge about stocks, futures, and other products traded on Bursa Malaysia. You can easily access Bursa Academy by scanning the QR code on your right here, or by searching for Bursa Academy on Google search to find the link. So you can visit Bursa Academy for more detailed information and resources. It's a valuable resource to enhance your understanding of trading in Bursa Malaysia. All right, we have come to the end of our webinar session today. Thank you, Yixuan, for sharing such an informative session with us. And to all of you who joined us, thank you for your participation. We hope you found this webinar both informative and valuable. And I believe you have gained new knowledge in how to do spread trading and trade the derivative markets better. So with that, I'm CY signing off now. Enjoy the rest of your day. Good night, goodbye, and until next time. Bye.